Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today in our economy show, we have a lot to cover. We have yields, which we've been talking about, interest rates. What does it mean? How is that impacting what central banks are going to do, what international banks are going to do, and then really how is the U.S. consumer faring as we have new stimulus that is now being pushed down into their bank accounts. So there's a lot of things that we're going to try to go through. We'll break it apart into more of a global view. Then we're going to look at more U.S. data with looking at how are yields impacting, what's the consumer. Then we're going to go further into the job side, and then Europe, and then finishing up with Asia as we get ready for some more interesting data coming from China. So before we get into it, again, we'd like to ask you to like, share, subscribe. Your support is appreciated. So the one thing that we wanted to kick off with, because I think it's important when we're looking at the PMI input cost indices. So we keep talking about cost and why is it so important? And if you watch the EIA show, we talk about gasoline and diesel prices, but there's just an inherent increase in just prices in general. So the U.S. continues to stand out in terms of input price pressure, which is only going to continue to pull higher as we have additional price increases that we are also importing. So these are some, I think, key bullet points of there are more signs of both cost and price pressure than is normal in the early stages of a recovery. So you have to think about, okay, well, we're obviously coming out of a certain amount of the lockdown, some of that residual is going away. So we have, some of this momentum. And with that momentum comes velocity of money. So as money starts to move through the system, we are so essentially glutted with this cash that is going to just rip through, which is going to accelerate. And this is where you start to get these concerns about overheating. But when you look at unemployment is saying something very different than what some of these prices are saying. So these are things that we're going to tease out as we go through this whole 5 segments. So the U.S. stands out like a sore thumb in both our own survey and outside surveys. Again, this is coming from IHS Markets. The euro area is at the other end of the spectrum, but that is also starting to accelerate, which is what we're going to cover in segment 4. Now, the source of inflation pressure will shift a bit as economies reopen, but we expect the U.S. to retain its very high level. So again, these are things that we're going to have to look at and consider. So as we start filming this, Powell has not come out and spoken yet, and that's something that by the time we get to the end of this, so we'll probably get a bit more information. But in the meantime, it's always important to give an idea of where are we in the cycle when we're looking at some of these 10-year, 30-year side. So here you can see the long end of the bonds when we're considering the 10-year and the 30-year continue to move higher. That rate of change is pushing back to those highs. And this is also factoring in that inflation side. So you can see that the 30-year is now back above in positive territory. And just the way these are coiling, we continue to think that unless we get some massive move from Powell, it is unlikely that we're going to see any type of change in the trajectory of these data points. And just to give you an idea of some of the things that we expect to hear, or at least to hear him talk about, really what is going to remain the SLR, which is that key leverage ratio which banks have been allotted. So the question is going to be, how is this adjusted? It's supposed to expire in March. Is it going to be extended? These are some of the key things that we're going to have to listen for, because it's going to be very important to see how does this impact the long and short ends of the curve, with the yield curve controlled, or the YCC is widely expected, just given where the long end is versus the short end. And that's why when we start looking at the different backdrops of the 10-year, and the reason why throughout the next 5 segments, because this is going to be peppered throughout, the 10-year is going to be so important, because a lot of the international markets price their debt off of our 10-year. So you can see that the trend has been continuing to move up. We're now at highs that we haven't been at since 2019. And this is why we're starting to see this expensive nature of these essentially the international community, where it's getting harder and harder for them to borrow, which again is becoming a bigger issue when we look at stimulus and what does stimulus mean, or at least trying to support the economy in some shape, way, or form. Now, when we talk about that yield control side, this is something that we're looking at. So this is taking the 30-year and then the overnight repurchase, which you can see has been essentially negative, which has pushed banks to essentially accept whatever is available coming out of the the Fed as some sort of backstop, which again comes down to what are the different components of how to kind of protect that overnight as we have more cash that's being delivered to people's bank accounts in terms of stimulus checks, whether that be direct deposits or checks, which is going to put more money into money market accounts and again is going to put additional pressure. So a yield curve, you would be buying long end and selling front end and essentially trying to flatten this out by giving some more liquidity to the short cycle and providing additional amount of buying pressure on the long side, trying to keep this within a certain amount of comfort as treasuries may lack demand, even if 10-year touches 1.75% and 30-year touches 2.5% as we continue to see the long end drift higher. Now, some people will say, well, let's put it into perspective. That the yields are still at historic lows. And again, that's not wrong. It's just what is the pace of change or rate of change that we have seen when we look at the yield curve. And that's why when we look at the 10-year, you can see just how fast this rate of change has been, outpacing a lot of these other key benchmarks over those trading days as Arbor outlines it. So that's why it is a little bit different, because it's not, one, we have a way more debt than we ever have before, but it's also the pace or the rate in which it's increased, which has kind of shocked the market and has created not so much, obviously issues for the U.S. as yields continue to go up, but also for the international markets, which are continuing to see their expenses going up and their inability to try to find some sort of support, which is why central banks have had to step in and continue to buy their debt. Now, when we look at the extra stimulus, when we see what the U.S. has done versus Japan and the EU, this is where the question becomes of, did we do too much? And that's when we start getting into the overheating, which is why the Powell comments are going to be important, because now that we've gotten such a huge increase in fiscal, will we start to see some of that monetary support coming off? I don't think so. I think this is going to be a very dovish statement, which is going to be very interesting to see how the market interprets this. But again, this is something where the EU is looking to start doing more, which is something that Lagarde has said, but we've kind of yet to see that. And we're going to have to continue to see what kind of support the Europe and Japan brings in, especially with Europe, who is now well behind on the vaccine side and starting to see an increase in cases, again, mitigating some of the recovery that we saw in different parts of the over Q1. Then when we look at just, what is the number, this kind of puts in perspective the fiscal support announced since December 20th. So you can see just the sheer size of the amount of points of GDP that we've been purchasing and how this is going to filter through the economy. So in other parts of this, of not this segment, but the next, we're going to look at, well, how much is going to stay in savings, how much of it is going to find its way into the market, and start to kind of, essentially massage out where is this really going to go and how much of a growth trajectory or trajectory are we going to be in, which is why when we look at the Europe, we think that there's going to be an increase in that fiscal support announced since last year, because we just need more of a stimulus, with Italy saying something similar and some of that coming to pass with, I don't see how they're not going to be an additional announcement. Now, looking at the vaccine side, this is the estimated vaccine distribution. You can see that we're well on pace in terms of getting to this level of comfort, with hopefully by the time we get into, let's say, the fall school season, we're going to be pretty much fully vaccinated, if not completely vaccinated. And right now they're doing testing on 6 months to 15 years old, which would then open up the ability to vaccinate children. Again, this is something that we're going to have to watch, because right now the U.S. is doing very well versus actually large parts of the world. So again, this is going to be that net driver of reopening, how much activity versus how much is there going to be a remaining on the employment side, because typically, or in the previous cycles, employment has been a lagging indicator, but given the sheer size and just how bloated a lot of these companies were coming into 2020, how much of that is going to be fairly sticky as we go through the remainder of the year. Now, these are some of those input costs. So looking at this in a different way. So let's take the Bloomberg commodity spot price, ISM manufacturing prices, Empire prices paid, and the headline CPI. So clearly, you can see that there is a very big difference between headline CPI and commodities, prices paid in the ISM and the prices paid in the Empire survey. We could use PMI, we could use anything. All of these prices and commodity prices are at, this chart goes back to 2014, are at all-time highs in this chart. But yet CPI is well off those peaks. So it just, again, CPI is going one direction. And this is what we continue to talk about when we're looking at how people are experiencing, their daily costs throughout their lives. So now let's look at what does this mean. So the 10-year yield, 10 years forward, which is that pink line, is the highest since 2019. Markets aren't just trading the size of the fiscal stimulus. They're trading checks, not automatic stabilizers, debt, not taxes. And what's seen as flirtation with MMT, which is why we're getting this rise in yields that is so robust. Now, this is coming from Robert of IIF. I've tweeted about him. He is a must follow in terms of some of the data that him and his team have put out. But this just gives you an idea of what that data tantrum looks like versus that taper tantrum. Now, mind you, all of this is happening without the Fed being hawkish. This is fully dovish, fully supportive, and it's happening here because it is more of the data side and what happens when these stimulus checks finally hit in general. And this is where we start to see some of that pressure. And again, it comes down to just the rate of change, which is the biggest concern. And the 10-year, again, is impacting the way the rest of the world is borrowing. So then when we look at top countries by the highest national debt, you can see obviously the U.S. continues to drive higher in terms of just the change in that debt level. When we look at 23.4 trillion, we're going to close out at 28.02 trillion. That's just so far for now as we're sitting at March 2020, and we have more time to go. So that debt number is going to get up. Which means that we're going to have more volume to bring to market in order to finance this because the tax receipts won't be there. So we have to hit the debt market in greater quantity. Japan continues to see growth while China has seen a small dip, but we're going to talk about what does that mean for China as we go into segment 5. Now, when we look at total deficits, primary deficits, and net interest, this is where we continue to see a growing problem as the deficit and then the interest side, because if we continue to see rates normalize higher and we start to see some of this robust moves on not only inflation, but also some of these other cycles, the problem is going to be the interest expense that is only going to continue to grow, which is just increasing the total deficit over time. So even though the primary deficit could remain, still see some growth, but say fairly flat, this is going to become an issue of how do we increase tax receipts or how do we cut spending, and hopefully both, in order to try to mitigate, because this pain is going to be a huge drag on the economy because the percentage of gross domestic product that's going to be impacted. And this is why when people say, think of the children, think about what we're putting our children, like the problems we're putting them in. This is what they're referring to when you see the overhang that is coming with this amount of debt that is going into the market. Now, the hope is GDP growth. The hope is increased tax receipts because people are going to be more robust, more sales. Again, these are going to be things to watch as we go into the next few years. Now, real GDP growth, you get an idea of what the drivers are. We've shown this before, but we just wanted to highlight it again. The U.S. is expected to be one of the bigger drivers of what is coming this year. China is the one that we remain concerned on, and we'll talk about why and how we actually got validation of this point in the most recent data sets. But this just kind of gives you a kind of backdrop of not only just the base effect, but where people are expecting the rest of the world. And We just remain concerned on what is that GDP growth actually come out to be, given European issues, some shortfalls in exports and just pricing increasing. And I'm writing an article today that's going to look at uprisings, what happens on the other side of a pandemic, epidemic, and how the prevalence of poverty in the world has increased exponentially, and why that remains a bigger issue and that kind of hindrance to what we see over the longer term. Now, when we look to the Chinese PPI, this is what we were saying of, the PPI is essentially telling us that as we continue to import, our prices are going up. So again, where PPI is and then where the US CPI, the trajectory is up when you're thinking about cost of living and what is going to happen going forward. So then when we look at the Treasury yield now, where we ended 2020, where we sit currently, and you could see that more and more companies and banks are starting to price in a greater increase on that years to maturity as the whole curve shifts up, which is, again, becoming a much bigger problem when we're starting to look at what is that activity going to be and what is the factors on inflation as debt continues to pile up. So federal debt as a share of GDP is set to double by 2050. Again, looking at the interest in a different way, which is why we continue to see this pressure to the upside. And to be clear, this doesn't even include the $1.9 trillion stimulus package. So we were already on a tough path. So now the question is going to be what happens going forward as this continues to trend higher. Now, this is also showing just where the fiscal deficit is accelerating. And when we look at 2020, which is that solid blue line, you can see that there is going to be an acceleration to the downside, which is why the survey versus the actual continues to get worse as we continue to see that actual piece getting squeezed in general. So then when we look at, what is the biggest tail risk going forward, here you can see the expectations, which has been a positive of, is not vaccine rollout. The vaccine rollout is no longer the key, concern. It's still a concern. There's still issues that can come about, but the issue is going to be what happens going forward. And that's when we start looking at inflation, and the bond market is becoming a bigger headwind to growth, as we continue to see inflation and some of these fears continuing to price themselves in. Now, this is another interesting thing, the deflation assets versus inflation assets. So deflation assets continue to accelerate to all-time highs. And the question now is going to be, well, after the Fed announcement, when is deflation going to cycle into inflation? Now, what are they? So inflation assets, according to B of A, commodities, real estate, tips, EAFE, U.S. banks, value, and cash, versus deflation, which is government bonds, U.S. high investment grade, S&P 500, U.S. consumables, discretionary growth, and high yield. So are we going to start to see a pivot which is going to not so much take all of this down, but have it converge in some way as more inflationary assets are purchased? And this is going to be, the short answer is yes, in my opinion, but again, we need to see some of this deflation start to roll over, and it's something that we think we're starting to get in the market right now. And that's why when we start looking at investors are record long commodities, which we've seen in grains, we've seen in crude, we've seen pretty much across the board in lumber and other. But that's why when we look at just the net speculation, we think that there's going to have to be a little bit of a pause, which is why we're going to get a bit of a reset in some of these holdings, especially on the commodity side. Now, U.S. real yields have risen at the long end, and this is where we start looking at the real yields once we factor in even the lowest end of CPI, even though we say it's higher, which means that that some of these yields have higher to go, because this is looking at U.S. TIPS indexes with greater than 10-year now positive, which is something that the Fed has been trying to look at and or realistically mitigate against as we see that additional fear of inflation coming through as the market bounces around after the Fed decision. So then on the increasing vulnerability, this is why we continue to talk about the emerging market side, because emerging markets are seeing a tighter correlation to the EM local currencies and that 10-year yield. So this is just showing you what we've been describing of just as the 10-year goes higher, so does the cost and the pain for some of these government yields abroad. But when we start looking at global industrial production, you can see that the bounce has been fairly quick. And now the question is going to be, how does it continue from here? So this is something that we've been saying, where we were going to get a strong bounce and then we were going to start to go sideways and then actually roll over a little bit. And this is something that we continue to see. Obviously, we have a new shot to the system. When we look at the general just activity of stimulus, that's going to provide a little bit of a bump, which should take us back above 0%. But then we're expecting a little bit, of a normalization. As we saw last time we had stimulus, you had a shot in the arm and it was gone quickly. And it's because, jobs still weren't coming back. You still had these overhangs. So this is something that will get a shot and then it'll start to kind of roll back over and start to show something more of like a double dip, which is going to be a bit of a headwind going forward. So those are some of the key aspects that we've looked at. And now we're going to look at the U.S. in more detail, especially as we factor in other pieces of the economy and what does it mean for U.S. growth going forward.